All right, ready to dive into some value investing.
Let's do it. Always a fascinating topic.
We're talking Benjamin Graham today.
The legend himself.
His book, The Intelligent Investor, it's basically the Bible for anyone who wants to, actually understand how to invest.
Yeah. Forget those get-rich-quick schemes, right?
Exactly. This is about those timeless principles.
Right. And you picked out some excerpts, so I'm excited to dig in.
Yeah, and we've got some great commentary from Jason Zweig, too, to bring it all into the 21st century.
Oh, Zweig's insights are always spot on. This is going to be good.
So should we just jump right in?
Yeah, let's do it.
Okay, so the intelligent investor. What does that even mean? Do you have to be like a math whiz to get this stuff?
That's what's so interesting about Graham's approach. It's not about having a genius IQ. It's more about,
Temperament.
temperament. It's about being disciplined, patient, thinking for yourself, not getting swept up in the hype.
It's like, remember back in 99, the dot-com bubble? Everyone thought they were a stock market guru.
It was crazy.
And then boom.
Crash.
Exactly. And Graham, he totally called it.
He understood that markets are emotional. They get carried away.
And that's where the whole intelligent investor thing comes in.
Yeah.
They're the ones who could see past that.
Exactly. They're not driven by fear or greed. They're looking at the fundamentals. They're thinking long term.
So it's less about trying to time the market
Way less about that.
and more about understanding the businesses you're investing in.
Exactly. Think of it like this. You're buying a piece of a business, not just a stock ticker.
And that's a really important distinction that a lot of people miss, I think.
Totally. It's easy to get caught up in the excitement of the market, the ups and downs.
Oh, for sure.
But Graham, he wants you to tune all that out.
Block out the noise.
Exactly.
So how do you do that? How do you actually become one of these intelligent investors that he talks about?
Well, he lays out a whole framework.
Yeah.
And it starts with understanding this idea of intrinsic value.
Okay, intrinsic value. That's about figuring out what a business is actually worth, right?
Right. Like, what is it truly worth, not just what the market says it's worth at this particular moment.
And that can be tricky, right? Because the market is,
Well, fickle.
yeah, fickle, emotional, up 1 minute, down the next.
Exactly. It's like that friend who's always got a new crazy scheme. You can't get sucked into their drama.
It reminds me of that story Graham tells about Northern Pipeline Co.
Oh, yeah.
He finds this company, it's trading for like $65 a share.
Right.
But then he digs into their books, and it turns out they've got all these bonds, right?
Hidden assets.
Exactly. And those bonds, they're worth like $80 a share. So the stock was trading for less than the value of the bonds they owned.
That's the kind of opportunity that Graham was always on the lookout for.
Hidden value.
Absolutely. And it's out there, but you have to know what to look for.
So how do you find those hidden gems? How do you actually determine a company's intrinsic value? It seems pretty complicated.
Well, it's definitely not as simple as just looking at the stock price.
I would imagine not.
It's about analyzing the business, digging into the financial statements.
Right, because those financial statements, those can feel like a foreign language sometimes.
They can be intimidating for sure, but Graham provides tools and techniques to help you make sense of them. He wants you to really understand the business behind those numbers.
So it's about being a detective, basically.
Exactly.
Looking for clues, trying to figure out if a company's the real deal or just smoke and mirrors.
And that's especially important with those so-called growth stocks.
Oh, yeah. The ones that everyone gets excited about.
The high flyers. They seem tempting, right? Prices shooting up like a rocket.
But what goes up?
Must come down.
Exactly.
Graham has a great example in the book Texas Instruments.
Oh, yeah. What happened there?
Well, back in the late 50s, their stock price, it was skyrocketing, like 5 times faster than their actual earnings were growing.
So the hype was outpacing reality.
Exactly. And guess what happened?
It crashed. Ouch. Even IBM, which was like the tech giant of its day.
The Apple or Amazon of its time.
Right. Even they had some major price drops.
It's a reminder that even the seemingly sure things can be risky.
And that's why understanding value is so important.
It's about separating the hype from the reality.
So you don't get caught holding the bag when the music stops.
Exactly.
So how do you know if you're getting caught up in the hype? How do you, separate the companies that are truly valuable from the ones that are just like smoke and mirrors?
That's where Graham's detective work really comes in.
Okay, so put on your deerstalker hats, everyone.
He gives you the tools to analyze a company's financial health. And one of the biggest things he stresses is this concept of margin of safety.
Margin of safety. Okay, I think I've heard that term before, but remind me.
So imagine you're buying a car,
Right.
right? And the seller, they're asking, say, $10,000. But you, being a savvy negotiator, you do your research, you check out similar cars, you look at the car's history, and you figure out that it's really only worth like 8,000.
So you've got that $2,000 cushion.
Exactly. That's your margin of safety. You're buying it for less than it's worth, just in case.
Just in case there are hidden problems or the market takes a dip.
Exactly. And it's the same thing with stocks. You want to buy them for significantly less than what you believe their intrinsic value is.
So even if you're wrong about something, you've built in a buffer.
Exactly. It's like that old saying, don't lose money.
Right. Makes sense. So where does Mr. Market fit into all of this? Because Graham, he loves to talk about Mr. Market.
Oh, Mr. Market. He's like that unpredictable neighbor who's always got a deal for you.
Okay.
Some days he's euphoric, everything is amazing, the sky's the limit, and he's offering you crazy prices for your stocks.
Right. Like this stock is going to go to the moon.
Exactly. But then the next day, he shows up at your door, totally panicked, the world is ending, and he's practically begging you to sell your stocks back to him for pennies on the dollar.
Oh, so he's emotionally unstable.
Completely. And the worst part is he never stops with the sales pitches. He's at your door every single day trying to get you to buy or sell.
So how do you deal with that? How do you not get sucked into his craziness?
That's the key, right? You have to remember, Mr. Market, he's not your friend. He's not your financial advisor. He's just there to make a buck.
So don't listen to his advice.
Exactly. In fact, Graham says you should do the opposite. When Mr. Market is euphoric, be skeptical. When he's panicking, well...
That might be a buying opportunity.
Exactly. Take advantage of his mood swings, but don't get swept up in them yourself.
So stay calm. Keep your head when everyone else is losing theirs. That's classic Graham, right?
Absolutely. And that's where the discipline and the temperament come in.
Okay, so let's talk about some of those specific tools and techniques that Graham gives us. He's got a whole chapter on like analyzing financial statements, and gotta be honest,
Yeah.
sometimes that stuff makes my head spin a little bit. It can be pretty dry.
It can be a bit much. It's definitely not the most exciting part of the book, but...
But it's important.
Oh, absolutely, because this is where you separate the wheat from the chaff. This is where you find out if a company's story actually adds up.
Okay, so give me like the crash course. What are some of the key things that Graham wants us to look for when we're diving into those financial statements?
Well, first and foremost, he wants you to be skeptical.
Okay, healthy skepticism, check.
Don't just take the numbers at face value.
Yep.
Companies, they can get creative with their accounting.
Oh yeah, they definitely try to paint a rosy picture sometimes.
Exactly. So you have to know what to look for. Like, keep an eye out for those non-recurring charges that seem to keep recurring.
Right. Non-recurring except for every quarter.
Exactly. Or companies that are addicted to debt, constantly borrowing more and more money to fuel their growth. That's a red flag.
It's like building a house of cards.
Exactly. One good gust of wind and the whole thing comes crashing down.
So we're looking for solid foundations, companies that aren't going to collapse at the first sign of trouble.
Precisely. And that brings us to one of Graham's biggest cautionary tales. The AOL-Time Warner merger.
Oh boy, yeah. That was a disaster. But wasn't that like after Graham's time?
It was, but it's the perfect example of what he was warning against.
Okay, so remind everyone what happened with AOL Time Warner. This was back in what, 2000?
Yeah, right at the peak of the dot-com bubble.
Right. Everyone thought the internet was going to change everything.
Exactly. And AOL, they were like the darlings of the internet.
They were. Everyone had that little CD-ROM.
Right, so they merged with Time Warner, this huge media conglomerate, in this massive deal, like over $100 billion.
I remember it was huge news. The future of media, they said.
Exactly. But guess what?
It didn't work out so well.
Not at all. The dot-com bubble burst. AOL's stock price plummeted, and the whole thing just imploded.
It was a mess.
A total disaster. And it's a reminder that even the sure things, the deals that everyone's talking about, they can blow up in your face.
So how do you protect yourself from that? I mean, is it even possible to beat the market when everyone else is like chasing the next AOL?
That's the million-dollar question, right? And Graham, he actually offers an interesting answer to that in his book. He tells this story about the 9 coin flippers of Graham and Doddsville.
Okay, coin flippers. Tell me more about this.
So imagine you've got 9 ordinary people flipping coins, right?
Okay.
And against all odds, they all land on heads. Again and again and again.
What are the chances?
Astronomical. But that's what these 9 investors were like. They consistently beat the market year after year.
So what was their secret? Were they just lucky?
Well, that's what's so interesting. Their secret was simply that they followed Graham's principles. They were all value investors, and they all shared this one common trait.
Okay, I'm on the edge of my seat here. What was the trait?
They bought businesses, not stocks.
What's the difference?
It's subtle but crucial. They saw past the ticker symbol, the hype, the daily fluctuations of the market, and they focused on the underlying business. They were looking for companies that were trading for less than they were actually worth.
Hidden value. We're back to hidden value.
Exactly. And they were willing to be patient, to wait for that value to be recognized by the market.
So it's not about trying to time the market perfectly or jump in and out of stocks every 5 seconds.
Not at all. It's about doing your homework, finding those undervalued companies, and then having the discipline to hold on to them, even when Mr. Market is having one of his meltdowns.
So it's more like being a marathon runner than a sprinter.
Exactly. And that's a really important takeaway, because in today's world, everything is so fast-paced, everyone wants instant gratification.
Oh yeah, just look at social media.
Exactly. But investing, true investing, it's not like that. It's about playing the long game. It's about tuning out the noise, drowning out the hype, and focusing on what really matters, the underlying value of the businesses you own.
So we've covered a lot of ground here. We've talked about intrinsic value, margin of safety, Mr. Market, the importance of temperament. It's a lot to take in.
It is a lot, but that's the beauty of Graham's approach. It's simple, but it's not easy.
Right. It takes discipline. It takes patience. And speaking of patience,
Yes.
one thing that I've always struggled with is this idea of like comparing myself to other investors. Like you see someone on social media bragging about their latest stock market win, and suddenly you feel like you're falling behind.
Oh, I know exactly what you mean. It's so easy to get caught up in that game of keeping up with the Joneses, especially in the age of social media.
Right. Everyone's highlighting their best moments, their biggest wins. It's easy to feel inadequate. But Graham, he actually warns against this, right?
He does. He says, and I'm paraphrasing here, but he basically says, don't compare your insides to other people's outsides.
Oh, I like that.
Right. You never really know what's going on behind the scenes.
Exactly. For all you know, that person who's bragging about their stock picks, they could be up to their eyeballs in debt.
Exactly. Or they could have just gotten lucky on one or two trades. It doesn't mean they have some magic formula.
Right, right. So it's about tuning out the noise, focusing on your own goals, and sticking to your plan.
Exactly. Graham, he wants you to be your own benchmark. Compare yourself to your past self, not to some random stranger on the internet.
Okay, that's a good way to think about it. So where do we go from here? We've learned all these great principles from Graham, but how do we actually put them into practice?
Well, that's where the real work begins. But Graham, he doesn't leave you hanging. He provides specific guidance for both defensive investors and enterprising investors.
Okay, so let's break those down. Who's a defensive investor?
So a defensive investor, they're someone who prioritizes safety and stability above all else. They're not looking to get rich quick. They're happy with slow and steady growth.
Okay, so they're playing the long game.
Exactly. And for them, Graham, he recommends a very simple diversified portfolio, a mix of stocks and bonds.
How much of each?
He actually gives a specific recommendation, at least 25% in bonds and no more than 75% in stocks.
Interesting. So even the most conservative investors should have some skin in the stock market game.
Absolutely, because over the long term, stocks, they have the potential for higher returns than bonds, but you don't want to have all your eggs in one basket.
Right. Diversification is key. So if someone's listening to this and thinking, okay, I'm a defensive investor, I like that slow and steady approach, what kind of stocks should they be looking at?
Graham, he was a big fan of what he called well-established companies, companies with a long history of profitability, a strong track record of paying dividends.
So blue chip stocks, basically. The Coca-Colas of the world.
Exactly. Companies that have stood the test of time. They might not be the sexiest investments, but they're the ones that are going to weather the storms.
Okay, that makes sense. Now, what about those investors who are a little more adventurous, the ones who are willing to take on a bit more risk for the potential of higher returns?
Yes. The enterprising investors.
The ones who like to live a little dangerously.
Exactly. And Graham, he has a whole different set of recommendations for them.
Like what?
Well, for starters, he encourages them to be more active in their research. They're not just looking for those well-established companies. They're digging deeper, trying to find those hidden gems, companies that the market is undervaluing.
So more detective work.
Exactly. They're poring over financial statements. They're looking for companies that are trading at a discount to their intrinsic value.
They're bargain hunting.
Exactly. And they're willing to be patient to wait for the market to recognize the true value of those companies.
So it's a more hands-on approach for sure.
It definitely is. And it requires a certain temperament. You have to be comfortable with a little bit of uncertainty.
And you have to be able to control your emotions, because when you're hunting for bargains, sometimes you have to buy when everyone else is selling.
Exactly. And that can be scary. But as Graham teaches us, that's often when the best opportunities present themselves.
When everyone else is panicking.
Exactly. That's when Mr. Market is most likely to offer you a great deal.
This has been fantastic. I feel like we've only just scratched the surface of The Intelligent Investor.
We really have. There's so much wisdom packed into that book. It's one of those books that you can read and reread and still find new insights every time.
Absolutely. So for anyone listening who's feeling inspired to learn more, to dive deeper to Graham's world, what would you say to them?
I would say pick up a copy of The Intelligent Investor and start reading. It's the best investment you can make, not just for your financial future, but for your peace of mind. Because once you understand these principles, once you learn to think like an intelligent investor, the market, it becomes a lot less scary.
It's no longer a mysterious casino.
Exactly. It becomes this incredible tool that you can use to build wealth, achieve your financial goals, and ultimately live a richer, more fulfilling life.
Well said. And on that note, thank you so much for joining us for this deep dive. It's been a pleasure as always.
The pleasure was all mine.
And to our listeners, thank you for tuning in. Remember, the key to successful investing is not just about being smart. It's about being patient, disciplined, and in control of your emotions. Until next time, happy investing.